Ladies and gentlemen, we're into our last session for the afternoon, which is about mobilizing financial capital. And just before we step into the panel discussion, I have Moody's Investor Services. Moody's are a strategic partner in West Africa and have been long-term supporters and members of us here in London and across the continent. So I'd love you to put your hands together and welcome Lucie, Vice President, Senior Credit Officer, Moody's Investors.
Thank you. Hi, everybody. I'm afraid this is the moment in the conference where we're going to have to focus on the challenges. As a representative of Moody's rating agency, I have to state at the beginning that we've moved our focus from the pandemic shock to tighter monetary policy to now price shock. And that this price shock, of course, is affecting all emerging market countries, including in Africa. But you will see what I'm going to depict is not all negative and dark. There are interesting positive stories also down the line. So what I propose to start with is maybe the anatomy of the current shock that I mentioned. If we focus on emerging markets outside Europe, because Europe is a bit of a specific case, but I think we can say that the main channel of transmission is the first one, commodity price and supply shocks. What does it mean in practice for emerging markets, including in Africa, is two things. The first one is higher inflation. I think it's pretty obvious and well known. What it means is that purchasing power will deteriorate greatly in countries where savings are low. That's the case in emerging markets and in Africa. And that the second phase of the shock will be when volume adapts. And when I say volume, what I mean is that the demand will have to adapt, the economic growth will have to adapt. That means a deterioration in the growth outlook. The second case, which is probably a bit more nuanced and affects very differently emerging markets, including in Africa, is the fact that you have what we call a deterioration in the terms of trade. That's a bit of a barbaric term to explain that you can be in a situation where the prices in your export will increase, but that will not offset the higher prices of your import. And what does it mean is that your currency is going to depreciate against the dollar or other main currencies. And what does it mean is that ultimately that exacerbates your inflation because the imports that you have will cost even more when your currency is weaker. So that's really the key second impact that we're seeing in emerging markets, including in Africa. So this negative feedback loop, you can ask me, what's the way out? And of course, we don't advise. But what the textbook would tell you and what typically an IMF program would say is, one, you don't entertain inflation. So wages should not be revised in line with inflation. And second, you use your fiscal stimulus to support the economy and the most vulnerable in your population. So a very targeted fiscal stimulus. The issue, of course, is that the public finances, as I'm sure you know, are not in such a good shape. They have supported the economy to a great extent during the pandemic, and yet there is another shock that is going through, and that's going to affect the public finances. So in the mitigants that we explained there, you have the extent to which governments can again support the economy through that new shock. And of course, the issue is that those countries with the budgetary room for maneuver are not necessarily those countries that need the fiscal stimulus, and that creates really pocket of vulnerabilities. So now maybe focusing more on Africa. This is the first time in several times, this is the first time in 2 years, I think that I'm presented this wheel. We show what is very important for you is the number of green and red. You may not see the names of the countries we cover in Africa, which is fine. But we do have greens, which is the good thing, and these are the positive outlook on our ratings, again, on the African continent. Of course, you have more red, as I'm sure you all realized, and the red are the negative outlook. Many of them have actually been there before the shock to price. Only I think Egypt is a recent negative outlook because vulnerable to this precise shock. But you have also recent positive outlook, which I think, as I said, I promised that I would not be all negative. We have very recent positive outlook on Ivory Coast. It was changed end of June. So we knew the shock was there. Ivory Coast, as part of the WAMU region, so the economic union, is susceptible to that shock. It is a net importer as a region again. The WAMU is a net importer of oil and food, 9% of GDP we estimate. Yet we believe that the economy and the institutions are probably strong enough to absorb and overcome the shock. That's what we're indicating with our positive outlook. I just wanted to finish this session with a few graphs showing basically the order of magnitude of the deterioration that we are expecting. The first one is on inflation, and the idea was to say we are prepared for record high inflation. There's a lot of uncertainty around what the end point at the end of 2022 will be, and actually it may be higher, if anything. But again, the idea was really to say record high inflation. The second one is current account deficit. As I explained, the terms of trade shock, the fact that the prices of your imports may not be outweighed by the higher prices of your exports. That's what you're seeing there. We're not yet in the situation as we've seen in 2014. You may remember, I know 2014 is a long time ago, but that was when we had the last big oil price shock. We're not at this level, and one reason for that is that African countries are for some part important export commodities. And in this current shock, it's not just oil that is more expensive, but some of the commodities that are exported have seen their prices going up too. And that's the reason why we don't expect at least, that current account deficit would reach the record high level we saw in 2014. The two other key macroeconomic ratios that we like to look at and that are good to illustrate this ongoing shock and what we expect is the real growth, as I said, higher inflation. What does it mean? It means that purchasing power will have to adjust, and that means demand will adjust, and so economic growth will adjust. That's what we're seeing. Again, the idea is really to tell you that this arrow that you're seeing at the end, the extent to which it will really point upward or not is very uncertain. And again, if there are any risks, it's more to the downside. The last one is general government debt. Of course, we're a rating agency and we rate all these sovereigns and countries. And we know that the governments have had to take a lot of debt during the pandemic and during the previous shocks that I mentioned. And what I wanted really to show there is that we are not yet to the levels that we've seen in the early 2000s, which basically corresponds to the moment where certain countries in Africa and elsewhere in the world, Asia, Latin America, received debt relief, but we are not far. And so this is just, to put into perspective the fact that, debt is higher and budgetary rooms for maneuver smaller than they used to. With that, I finish this session. I think I've done 10 minutes, so unless there are any questions, of course, on the presentation, on anything. I don't know.
Gregory Cronston. Just a very quick one. I mean, I'm not a pessimist by nature, but some people are talking about, a new round of old-style Paris Club rescheduling, bring back the new Brady bonds. So what would you like to say about it?
Sorry, about Paris Club, I couldn't hear.
Second round of old-style Paris Club rescheduling and second issuance of Brady, or give them a new name, bonds.
I didn't catch the last part, sorry, I must be...
A second issue of Brady bonds.
Green bonds.
Yeah.
Okay, green bonds. Breeding bonds. Okay, Grady bonds. Okay, sorry. I don't have good hearing on my right-hand side, so... So, no, Paris Club, as I'm sure you all heard about, there is a framework to help most vulnerable countries in relieving debt. Under this framework, what it says, and it's something that actually has been a common theme in past debt relief exercise, the ones that I mentioned 2 decades ago was the same, is that very often you have what we call the clause of equal treatment between all creditors. So this idea that whether the creditor is a multilateral development banks, we've seen some today present, whether you're an institutional investor, we saw one also today, whether you're a bank, there are some in the room, you should be treated in the same way. What does it mean from a rating agency purely is that from the moment the private sector creditors are affected, it's very likely that there will be a loss and so a default as per our definition. We of course understand the broader objective of this exercise, which is to lower the debt burden ultimately to the government and free resources for probably more strategic and more important objectives. But from, again, a private sector creditors, which is what our ratings speak to, that's a loss, a default, and so that means a low rating. I don't know if that was clear. It was?